The surge in precious metals is relentless. We're going to be covering that, as well as the Federal Reserve meeting, the slide in the dollar, and tons of market-moving earnings that are coming out right as we speak. But first, I want to give a shout out to our sponsor, Fiscal.AI. It's where we get all of our fundamental equity data, where we do all of our research. You can get 15% off any paid tier with Fiscal.AI/MM. Let's get into it. Max, great to see you. We got a lot to talk about today. What's on the docket?
I think there's no other place to start but precious metals, Jack. I mean, as we spoke before this, you mentioned that gold, of the however many trading days we've had this year, only 3 of those days have been down. We've had 8 consecutive up days for gold. What do you think of this continued move from the precious metals complex?
Well, first things first, Max, I'm going to let our viewers in on a little bit of a secret, which is there is macro trading and macro hedge funds. And some of the excellent returns from macro hedge funds do come from big macro calls about the dollar is going to do this, silver is going to do that, the stock market's going to do XYZ, labor market, Fed, currency, yada, yada. That is a legitimate part of macro trading, but a lot of macro trading is a systematic trend following of basically gold was up on Monday, Tuesday, Wednesday. The odds that it's up on Thursday is slightly elevated. Let's take a long position there. And I think that is that is evident in the rally in gold, Max. So I think roughly 18 trading days so far. At least in the Monday through Friday, and yeah, every one of them for the GLD ETF for gold, save for 3, was up. So it's just a tremendous surge, and it's gold's above 5,300. Silver is I believe still over $110, which is ridiculous. Max, I think that for gold it's monetary, for silver it's industrial. I know a lot of people, silver and gold are correlated. So some people say that the surge in silver is monetary and it is part of the debasement trade. I think that for me, the debasement trade is kind of just a marketing term. It is, let's be real, Max. Whatever bank it was, like all the big banks had their clients in their gold allocation was 0% or 1%. So their clients missed the big move by and large. And then some smart analyst, probably a young analyst, let's be honest, came up with like let's write something called the debasement trade and pretend like we haven't been massively underway for our clients. So I think silver really is industrial. I covered that dynamic on our previous episode. And Max, I'll just say this again, that like the 1981 high in gold, the Hunt Brothers squeeze, extremely speculative. It was tons of speculators piling in. The 2011 surge, and really the 2006 to 2011 bull market in silver, which was the second half of the bull market that began in 1999, 2000, was very speculator driven. There for many of those years, from 2006 to 2011, a lot of those years there actually was a surplus in silver. So it was a speculative driven market, and the reports from that time indicate that it was a speculative driven market. Even the kind of pro silver, if they had a bias, it would be pro silver reports at the time were saying this is investor driven. That just look at the numbers of industrial demand, technically industrial solar demand was actually down slightly year over year. So the deficit got slightly less big, but the drawdowns are real. And a ton of incredibly accomplished investors and longtime precious metals bulls, such as Rick Rule, have actually kind of made some calls saying, "Oh, I've sold some percentage of my silver." And by the way, some of that he went into cash, some of that went into silver miners. But some people are kind of sounding alarm, saying that I think this is the rally in silver is over. I could go either way, but I don't know. It seems to have legs for me. Max, Jay Powell today was asked about gold and silver. So let's be real. A lot of people, some people watching have been very long gold and silver in various stocks. I myself have participated in that rally, and that's great on the investor side. I don't think it says phenomenal things about the health of global capital markets, in particular U.S. dollar capital markets, that gold and silver are so high, particularly gold. Silver, there's a tremendous shortage. People have been underinvesting for years. Okay. But I mean, you have some major allocators and funds all around the world. Some institutional investors in Canada, the sovereign wealth fund of Azerbaijan, like everyone is going into gold. And I don't think that is amazing for the world, to put it mildly. It's very good for gold investors though.
Well, Jack, the bull thesis for the dollar and dollar denominated assets has been that it is the cleanest dirty shirt. And well, if you look around the world and you look at everybody's shirt and you say everybody's dirty, maybe we should return to nature and go nudist. That is what the move to gold somewhat feels like. But if you ask people, and look, we think very highly of our viewers and our commenters. Our last video, we talked a lot about gold and silver. And if you go through, you got every sort of answer. You got people saying it's central banks. You got people saying it's industrial demand. You have people saying it's speculative. You had very few people saying that the top is in. I will say that. But if when it comes to what is the driver of precious metals, there were all sorts of answers from people. And it's one of those things. Same thing with Bitcoin, right? It's just always hard to tell what is driving it. And it's part of the reason that picking the top can be so difficult. But one of the reasons that a lot of people have been talking about has been the decline in the dollar, and that people are concerned about the dollar specifically, and that's why people are rushing into gold. We did recently hit a 4-year low in the dollar. We've bounced actually today after some comments from Scott Bessent, but the dollar has been sliding. Do you think that is really the key driver of this precious metals rally?
I've been wondering about this myself, Max. I don't fully understand why a weakening of the dollar is bullish for gold, other than the simple fact that gold denominated in dollars, when the dollar goes down, gold goes up. I don't fully understand the dynamics. And I think, if people have any ideas, please mention it in the comment. Interestingly, President Trump, when asked about the fall in the dollar and why is the dollar so weak, he said, "I think it's great." And so I think that caused a further fall in the dollar. I will say, Max, I look at the global financial system, and the dollar is extremely richly valued. You go to China, and you can buy things for so much cheaper. China, India, almost every country, maybe except Switzerland or Luxembourg, or tiny countries that rely on banking as a dominant industry. The dollar's overvalued. And that's why the dollar's overvalued, because there's such a flood of capital into the U.S. dollar for U.S. dollar assets. So I actually I don't think that a fall in the dollar is terrible for uh, America or the world. I think it could cause the foreign assets to outperform, as they have been last year in local currency terms, but also when you take into account the fact that the U.S. dollar weakened, uh, the rest of the world outperformed. So, yeah, I think that I think the seeds are there for U.S. dollar underperformance. It's interesting. It seems to me to be a little bit of a crowded trade. You look at what this macro fund manager said, what the other one macro fund manager said, the fund manager surveys. It seems like there are a lot of people, like, who are bullish on emerging markets particularly, and I I'm not sure, like, what is going to cause that trade. I do believe in catalysts. So with the benefit of hindsight, we know that what caused the dollar bear market, starting in 2000, I would say it was the commodity bull market, which benefited commodity producing countries like South Africa and Brazil. And those countries were a far bigger percentage of the emerging market index back then. Uh, and it also was the rise of China, which just reported phenomenal, insane level of growth. And it also was the birth of the euro, which, for reasons that I don't fully understand, to be honest, it made people very, very comfortable in investing in euro assets. And I think before, it's like, oh, I have to invest in, if I want to invest in the Spanish market, I have to get Spanish currency. If I want to invest in the Italian stock market, I have to get Italian
Lira.
lira. And this made it far easier. And as such, you had, huge speculative bubbles in particularly the real estate market. I mean, anyone who says, like, oh, the great global financial crisis, the real estate bubble was just in America. I mean, look at Spain, look at Greece.
But Jack,
I
there
think,
there
yeah,
is there are other policies at play here, and there is a concerted effort from the Trump administration to throw America's weight around in the global economy. And look, the size of US capital markets is just so much larger. And it doesn't take a lot of repatriation of capital back to local markets to really move things around from a flow perspective. And so it seems like a small number, but I mean, if you just look at that, doesn't mean that these countries don't have wealth, right? The wealth is just saved overseas in US assets. So if a small percentage of wealth comes home, then it can have a huge effect. And that's somewhat what people are betting on. You also have just the Donroe doctrine and the focus on the Western Hemisphere. I mean, one of the hottest areas in the market right now is South America. And so you have the combination of the success story that at least look, people in financial markets are a little bit more libertarian, a little bit more free market oriented, and so they are going to look at Argentina and say this is a huge success. And um, countries in Latin America are kind of moving in that direction, whether they're doing it on their own like Argentina or it's being forced upon them like Venezuela.
A little push. Yeah, a little
Yeah,
push.
a little bit of a push. So these things are happening around the world. You've got the US trying to make inroads with all these countries that have cozied up with China. I mean, I think that there could be some money coming from us too.
Totally. And so, Max, we'll cover the flows in a second, both in terms of where is the actual money going into the country to buy the assets of which country, as well as once you make those allocations or move the money around, how are you hedging your FX exposure? Those are two different things. We have the numbers. We'll get into the numbers. Powell today was asked about the numbers. We'll get into that in a second. But I just want to say, Max, as we record in late January 2026, it the Donroe Doctrine and the fact that to the rest of the world, President Trump is defying so many norms and flouting so many unspoken codes of global commerce and finance, trading relations, geopolitics, diplomacy. That as a result, the rest of the world is going. Of course, they're going to diversify away from the U.S. dollar. It feels so real, Max, and that's why we're seeing the headlines, we're seeing the research notes, we're seeing people in the comments say this. Okay, sure, it feels real. But okay, look back at 2000 again with the benefit of hindsight. Those three forces: the creation of the euro, the supercharged growth in China, as well as the commodity bull market. Those were incredibly real. Like on the real scale, they were 10 out of 10. They actually happened. They weren't just narrative gossip. Like, what are the chances that 5 years from now we will look at the current geopolitical situation and say, okay, yeah, President Trump, did he rock the boat in international politics as he did during his first term? Yes. But I mean, come on, those people who thought that it would cause a huge outflow of U.S. dollar capital markets, those people were fools. They believed the narrative. Like, what are those odds? And Max, emotionally, I kind of I agree with the headlines. I kind of feel like, okay, yes, I believe that. But just Max, I and other people who've paid attention to financial markets for a little bit, like you've been tricked before. We've been Charlie Brown taking the football away. I mean,
Well,
uh,
and how much of it is a we're looking out and projecting what we believe here in the US is happening onto the rest of the world. I mean, we were taught you talked about global macro, and that is a bit of trend following. We were looking at, one of the better performing global macro hedge fund ETFs ahead of this and looking at the holdings of it. You can't really see the holdings of private hedge funds, but the ETF, what is it?
Yeah, Max. I mean, we don't do free marketing on this program, to be clear, but as everyone knows, they're mega long. If you're a trend following program or a hedge fund, you're macro hedge fund, you're mega long stocks, you're mega long gold, you're mega long silver. And if you're not long precious metals as a trend follower, you're not a trend follower. Yeah.
Yeah, but Jack, I mean, it's worth just looking at look, the top they're long US stocks via futures, long gold via futures, long the Nikkei via futures, long emerging market bonds. Um, so it's you can create these types of flows just with US managers deciding that this narrative is true. It doesn't have to actually even come necessarily from the outside of the US. Like if we decide that it's happening here and a bunch of big hedge funds decide to plow a bunch of money into these smaller markets, it's going to move the price.
Yeah, and I also think, Max, it's what drives the narratives and the headlines is all of these. Can you believe he said that? Can you believe that this is done? But I think what really drives behavior in the long term is actions, and so certainly, in words, President Biden appeared to kind of rock the boat a little bit less than President Trump, to put it mildly. But I think during the Biden administration, the canceling of Russian foreign reserves, that was a kind of a wake up call to countries around the world. And I that basically, oh, you own I thought if you own U.S. dollars, regardless of your relationship, regardless of if you start a war, and if every country hates you, like dollars are dollars. In the same way that I could do anything, I could post anything I want on Twitter, but like if my bank account's my bank account. That's kind of how reserve managers around the world felt, and I think probably regardless of who was president, like that action probably likely would have been done, and I think it had the same response. Like I think the massive bid for central banks to buy gold. First of all, they demonetized massively during the 2000s. Again, Max, I think this precious metal bull market of the 2000s to 2011 that was so strong. There actually was extremely strong headwinds against it. As I said, in the latter half, there was a actual surplus of silver, and also central banks were demonetizing gold for the first 10 years. And so central banks have been buyers for the past decade, but they really accelerated it in 2022. And I think the price actually it was weak in 2022. Some have speculated that actually Russia was kind of selling gold to fund the war. That's an interesting view, but since 2023, gold has been in a massive bull market, and the squeeze really was this year. So I think that it is about actions. So in terms of bark, the President Trump's tariffs have been the loudest bark that has ever been heard around the world. But in terms of the bite, they certainly were less than expected. And I think that overall, institutional investors and diplomats and people making policy decisions generally focus on actions rather than words. So yeah, the Venezuela, that was real. Greenland, like maybe, I don't know. It won't be real until the president takes action. So words are different than action.
Jack, I do want to. It is Fed Day, so let's bring it to Fed Day. Powell, as you said, was asked about gold and silver, shrugged it off. He was asked about the dollar, straight up said, "We don't. That's the Treasury's purview. We don't have anything to do with that." So they're not stepping in to stop the slide of the dollar. They don't care at all about what's happening with the currency. But somebody did ask him a specific question about US dollar hedging, that yes, people did continue to invest in US assets, but according to some data from the BIS, that people were hedging their dollar exposures in ways they hadn't before. Now, you and I were debating whether he fully understood the question, because he pretty much dismissed it. That would be pretty rare for the Fed, I think, to just outright dismiss a report from the BIS. But it kind of made you say, I want to dive back into this and make sure that I have a better the correct understanding of the data. So we've talked about this before. Did people hedge their dollar exposures in 2025? And was Chair Powell wrong in his statement that he made today?
So, Max, you said it's rare for the Fed to contradict BIS data. It is even rarer for me to tell the head of my central bank, the Federal Reserve, that he or she is wrong. And I'm very loath to do that, regardless of whether that person is a hawk, a dove, or regardless of who appointed that person or what party appointed them. However, Max, yeah, that paper from the BIS, which there first was some data about the April 2025 sell-off, showing that during the tariff tantrum, let's call it that, global investors did not rush into the US dollar as they typically do. And then later in 2025, there was a very long paper by the BIS that had all these great charts, just showing that the flow of foreign assets into the US capital markets, the hedge ratio increased, and they increased unambiguously, and some of that was due to hedging costs, because as the yen rate goes up and the US rate goes down, that makes hedging more attractive. But basically, the hedge ratio did increase. The journalist asked about the hedge ratio, and we've got a chart right here. FX swaps and turnover growth in April 2025 were up 175% relative to 2022.
Well, Jack, that is just April, right? So we don't really know. Obviously, people's behavior was very different in that April period. The numbers that were being thrown around were way higher than what we ended up with. We know that the dollar flows returned. So there is some question as to whether that same hedging activity continued throughout the rest of the year. That was just an April phenomenon.
So yeah, your question is good. I'll keep that question in. Right, Max. So the paper from the BIS that was the subject of the question to Powell, that is specifically about April 2025. But I believe that other data from the year does show that hedge ratio increased, both because the dollar was falling and because hedging costs went down, but also because foreign investors wanted to hedge, and some of that could be this geopolitical risk premium that's very hard to sort of quantify, but we are seeing it in the data. I also say, Max, that just in terms of thinking about it, this is very pro-cyclical. You think, okay, if the dollar weakens against all currencies, then that should create, and if the dollar starts at fair value and then it weakens, that creates forces where it should return to fair value. But if you look at what I just described about how if the dollar falls, that makes other investors want to sell it. So this is why we kind of have these 10, 15, maybe 20-year periods of rising dollar, falling dollar. So I think it's important, and I think I disagree with Powell. The journalist's characterization of the BIS paper is correct, and I believe the BIS paper is correct. So let's get into the actual Fed meeting, Max. So the Fed had cut in the December meeting, and the interest rate futures were looking a little bit hawkish to me. I was thinking the Fed's going to, I think the Fed's, I thought Powell was going to come out today and indicate a little more of a softer tone. But I mean, the statement really set it off. Basically, the Federal Reserve looks at the falling unemployment rate, like it came out in the most recent data, and they think that the labor market's doing better than they thought in December and in November, and that inflation is still high. So the Federal Reserve had in December as well as before said many times that we're more concerned about the labor market than we are inflation, and that therefore gives a very dovish bias, and that's why they've been cutting for so long, even though inflation is above target. Uh, Now that statement was conspicuously absent from the statement. It was conspicuously absent from Powell's remarks and answers. And when multiple journalists asked him specifically about it, do you still have this observation that the Federal Reserve, is more concerned about the labor market than inflation? Powell didn't directly answer it, but the implied answer is no. That they don't have enough confidence to make that claim. So it could be that they are as concerned about the labor market as they are inflation. And they actually said that they are less concerned about both. So the upward risks of inflation and the downside risks to the labor market were moderately lower than they were in December. So I think that was the key takeaway. And interest rates across the curve, at least in short term interest rates, budged slightly higher. And also, Max, the Powell almost never indicates what the next decision is going to be. Going into this Fed meeting, the odds that there would be a March cut were quite low, below 20%. Well,
No, but for a month ago, Jack, it is below 20%. You had that right. But a month ago, it was about a coin toss for a March rate cut. So over the last month, we have really moved into a territory of people not expecting rate cuts. And more interestingly, if you look out to April, that is equally unlikely to see a rate cut at about 75% chance of us staying put. So the first Fed meeting, according to FedWatch, that we have expectations where the market is expecting rates to be lower is June.
Yeah, the market's even more hawkish than now. And so Max, like Powell almost never says in the next meeting, I'm going to do this. But today we got very close to kind of a wink, wink, nod, nod. A journalist, I believe Neil Irwin from Axios, asked about the odds of March rate cut. And of course, Powell went through the normal rigmarole that we're well positioned. We continue to make decisions meeting by meeting. We haven't made any decisions. But then he said, but the economy is growing at a solid pace, unemployment is broadly stable, and inflation remains somewhat elevated. So we'll be looking at our goal variables and letting the data guide us. So, I mean, he's saying inflation's elevated, unemployment's broadly stable when asked about March. So that to me is about as close as the handshake as Powell will ever make with journalists or the Fed. Again, he never promises anything, but it's looking extremely unlikely that there's going to be a March a cut in March. Of course, data can change that immediately. Also, Max, this is the first time in a while that Powell went very in depth on tariff inflation, and my interpretation was that he said that the bulk of tariff inflation has actually already passed, and that he said that I believe core PCE, or one measure of inflation for December 2025, was 3.0%. And that was the same as December 2024. So that sounds bad. However, service inflation went down, and all of that rise was it was goods inflation that went up, and that's actually a good thing because that means it's from tariffs, and if it's from tariffs, it's a one-time price adjustment. It is not systemic inflation. So hawkish across the board in my view, and I also think the market barely budged on that. So it just goes to show that it's not 2022 anymore. As I've been saying, in 2022, any hawkish surprises, the market would absolutely tank. We're not living in that world anymore, Max.
Well, I mean, I don't think the market was too surprised. We did talk about, I did mention the 1 month ago pricing on FedWatch, but if you look at the 1 day ago pricing on FedWatch, coming into it, we really didn't move that much. Maybe the April meeting, we got more. We went from 69% chance of staying to 74%. So we got a slight move in the hawkish territory, but the March was at 82.7, moved up to 86.5. So, the market pretty much had it, at least as of
Yeah.
yesterday. Now, yesterday isn't too far away, but I think the market was pretty well prepared for this. What is actually moving markets, it feels like, is earnings, right? We just had some pretty big earnings reports today. Microsoft, Meta, some of the SaaS complex that has been selling off pretty much every day, it feels like, also reported. Where do you want to start, Jack?
Max, I want to begin with Microsoft, but first I want to give a shout out to our sponsor, Fiscal AI. It's where we get all of our fundamental equity data, where we do our research on single stocks. The charts that we're showing today to our viewers are there from Fiscal, and with the link in the description, our viewers today can get 15% off any paid tier, including their max tier, which has downloadable data where they just slashed prices down over 50% to $800 a year. They're also making big pushes with their data API business. So if you want that seamless API capability, contact their sales team. Max, as promised, Microsoft earnings and revenue came in strong, above expectations. The stock is actually selling off, and I have a theory as to why. Number one, the Azure cloud growth was only, can you believe this, Max? Only 39%. How dare Microsoft Azure only grow at 39% year over year? Because, of course, last quarter, year over year, they grew at 40%. So I suppose the Wall Street's analysts were expecting a little bit higher. And then also CapEx was extremely high. So, of course, this is the money that Microsoft spends every year. The capital expenditure was $37.5 billion just in that quarter. So annualized, that's $150 billion. But of course, CapEx is increasing. So what does that number look like? 160? I mean, $200 billion? I don't know. We'll get into that in a second. And $30 billion of that was actual paid property and equipment, which is CPUs, GPUs, as well as property. And then other things I think are things like lease agreements. So a little more intangible. Also, Max, their performance obligations, remaining performance obligations, shot up over 110% to over $600 billion. So this is a non-GAAP metric, as legendary short seller Jim Chanos reminded us in December, that basically, if if I have a company and I sign a deal with you, you, Max, the individual, and you say your sales are going up by $300 billion, basically you can count RPO as it's not official revenue at all. And I do think that this will come in with revenue. So it is interesting that the market does not really is not wowed by the RPO surge as it was wowed, Max, back in the early summer of 2025, when Oracle reported this huge surge in RPOs and the stock shot up. Of course, Oracle stock has been in a brutal drawdown because investors are concerned not that the growth won't be there for AI, but that it won't be profitable for Oracle, or much lower profit margins, and also that if this customer is just OpenAI and maybe Anthropic as well as some other companies, VC backed companies that are losing tons of money, like, is that sustainable? Like, can OpenAI afford all of these all of these cash expenditures. So yeah, the era where just relentless growth in CapEx was going to drive the stocks of the hyperscalers higher, I think appears to be over. Of course, it could resume at any day. Needless to say, Max, this is exceptionally good for NVIDIA and the other beneficiaries of this spend. So when it comes to the CapEx guidance, CFO Amy Hood, she said that CapEx will continue to increase in the coming quarters of 2026 and that demand exceeds supply. Uh, so again, the narrative that they're saying, which I believe is true, is that they're capacity constrained. So they can't fulfill the AI demand that they're seeing, and so that if they had the chips, their revenue would be higher. So I guess maybe the investors are spooked by the capex. We'll see, Max, what the narratives settle on tomorrow and what the official narrative is. But that's what it appears to me, Max. What about Meta, which also reported?
Yeah, Meta reported they beat as well, but they are being rewarded. They're up over 8% after hours, and just a really strong quarter. They raised guidance above expectations for Q1, and just more traditional side of their business. It's not really anything fancy. It's just they're selling a lot of ads. They're making money on those ads. Impressions are up. The spend on ads is up, and pretty much across the board. It kind of not a boring quarter, but seems to be just kind of like their core business. I didn't get a chance to listen to the call or anything like that. Meta, interestingly, was kind of people were questioning their capex into AI before because they're not a hyperscaler, right? Like they're not going to benefit from the cloud, and the question was kind of always like, oh, what are they going to spend all this money on AI for? Are they going to make AI ads? Like how is that going to work? Are they going to become an AI agent on your phone? Um, and so there are still some questions out there about how Meta is going to make money on all of the sort of capex that they had planned. And we had some episodes about that, but didn't really seem to matter to investors right now. I think that was one of the charts that we looked at were the capex, um, the capex revisions over time for Meta and what people were expecting. And, they are still moving down, but not nearly at the same rate that we saw in the middle of 2025, where we saw these.
And Max, I know you're using fiscal, and that from an accounting sense is correct that the capex is is a negative number. It costs the company money. But when you said capex going down, you what you really meant is capex going up. On the
Yeah,
chart, it
yeah,
goes
yeah.
down.
Sorry,
Yeah, yeah,
the negative number for capex. That's what I'm
yeah, yeah.
talking about. So yeah, capex looks like a negative number, and you can see like on the charts that I have in front of me here in 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 the middle of 2025, we had this just huge, absolutely massive sort of like stair step down in the expectations for some of the quarters in 2026. And we are continuing to see that, but we're not getting like those same sort of like giant stair step functions that really scared people in the middle of last year. So, they, not that they have taken their foot off the gas, but it's just less of a shock to markets. And because their core business is just powering forward, people are happy.
It's interesting to me, Max, that Meta is now the beneficiary because I think a year ago the narrative and the argument, which to be honest I agreed with, was the following: Meta is spending all this money for itself. It's taking capital risk. It's taking principal risk. It's using its own money to spend on something for its own product. So if this doesn't pay off, the risk is to Meta. Unlike, Microsoft and Amazon, they're just spending the money for clients. They're spending the money because the demand is so high. So even if the clients don't, get the return on the investment, the Meta is still, sorry, Microsoft's still going to be paid. Amazon's still going to be paid. Google Cloud's still going to be paid. That narrative has now reversed because I think people realize who is spending this. Okay, it's OpenAI, it's Anthropic, it's the other VC-backed companies that are losing money. It's also some sovereign AI companies. All these Middle Eastern, very wealthy countries are involved in this game as well. But people don't like that business, and they say, look, Mark Zuckerberg, sure, he burned a ton of money in the metaverse, but he's got a good head on his shoulders, and he's his return on investment to improve the algorithms for Instagram, improve the reels, everything. We trust him. We see it. So I wouldn't have expected this a year ago, to be honest. But there we are. So Max, it's interesting. Microsoft optically, kind of exceeded its earnings for expectations. One company that did not exceed its expectations is Tesla. However, Microsoft sold off on beating expectations. Tesla missed, but rallied. What's going on, Max?
Well, it depends on where you look. Like if you look at the gap measures, they didn't they they missed, and some people like to cite their non-gap measures, and they would say that it's a beat. So if you go out online and you look for many of these stories, which are AI generated, that you can get from like Yahoo Finance and stuff like that, you would see that Tesla is up on an earnings beat. And if you look a little closer, it wasn't really a great quarter for Tesla. Car revenues, automobile revenues were way down. They weren't costs are up, and these were not capex costs. This was opex was up pretty high for the quarter as well. You are starting to see the energy generation and storage business is making money. It's not even close to the size of the automobile business right now, but as well, they have so many irons in the fire, and that is really one of the it's been a key tenet of the Tesla bull case for so long, is that it's not just a car company. If you think it's a car company, you don't understand Tesla. Look, by the numbers, it is at this stage still very much a car company, but
In the present, it is a car company. Company valuations are shaped by expectations of future cash flows. So there are those who make in the future it will not be a car company, and that is an argument, and that is why the valuation is very high and where it is. But yeah, at present, it is accurate to say it is a car company.
yeah, and so they have the humanoid robots that they're investing in, and that they're actually producing. I don't know how much they're selling. It wasn't like split out as a
Oh,
revenue line.
I do not think that is. I do not think they were selling. I've heard recent interviews with Elon Musk saying we're going to start selling humanoid robots by the end of by 2027, maybe by the end of 2026. So I don't think maybe they sold a couple, but I don't think they are in any scale selling.
So there's nothing really happening there. They are touting the growth in the robo-taxi miles driven. So they have just started removing drivers in Austin. They have cars on the road, I believe, in San Francisco as well, but they still have a driver assisting there. So the big question though is, are they really going to be the winners in that space? If you compare to Waymo, just the amount of miles driven, the rider or driverless miles driven on paid rides. So not just like, hey, we're going to send our cars all around. We're not going to put actual passengers, paid passengers. Like Waymo has millions and millions and millions of miles driven that are from paid passengers who are actually willing to get into a Waymo to drive them around. I'm not saying people aren't willing to get into Teslas to drive them around or anything like that. It's just, they're talking about 600,000 cumulative miles that they've driven, and individual cities, in some cases for Waymo, are up over like 50 million. So, but there is a question to be had, and this is like a bigger question about AI, which is like, where the model's going to get better is like the next million miles of like clean roads. Is that really going to be what makes the model better, or is it going to be looking at these edge cases, and is that something that the model is going to be able to like train itself on, or is it going to have to be more of like a manual question? So the miles driven is interesting to see, especially when you think about safety, because you just need to drive and drive and drive and drive and drive to really figure out how safe these things are. So it does prove out the relative safety of Tesla's autonomous robo taxis. But it's still very, very early stages there. So Tesla, still a story stock. Story is still intact. I think they announced a $2 billion investment into XAI. So you can call it's an AI company. I mean, it's always kind of had the AI aspects to it with the full self driving and the robo taxis, but now just more general AI exposure that way. And, we've been talking about how natural gas and sort of off grid power solutions are going to be important for powering these data centers. Arguably solar could be important too. And, one of the problems with solar is the intermittent nature of its power, and you need to store it. And so
Mhm.
if battery technology is utilized at all to power some of these data centers, there is an argument to be made that Tesla will have a hand in that. And that argument is the reason that I believe that Tesla's up despite what was a pretty underwhelming quarter in their core business.
Yeah, Max, underwhelming indeed. I mean, just looking at the automotive revenues, year over year, they were down 11% for the quarter. I suppose some of that is uh, maybe with the tax credit ending. So that was boosting their sales, and now they no longer have that. But I mean, the company's main business as right now is selling cars, and that business has been declining for uh, 2.5 years now, year over year. Some increases a few quarters, but most quarters down year over year. It really is remarkable, Max. I can't think of any other company that would have such a high valuation and be viewed, adored by many growth investors, have a PE of 50, 60, 100, and maintain that valuation while its core business is not only not growing, but is actually shrinking. I mean, you saw Microsoft being punished by the fact that its cloud Azure business is only growing 39% year over year instead of 40%. Not only is Tesla's, their sales are not 39% instead of 40%, it's not even zero. It's negative 11%. So I think it really speaks to the belief that many investors, some institutional investors, also let's be honest, many retail investors have in the vision of Tesla and Elon Musk's vision, and also his ability to execute, particularly not just in cars, but in humanoid robots, as well as in the robo taxis. He's been talking about full self driving robo taxis for many years, and the technology, is close, but I think on a regular, like I think Tesla full self driving right now is safer than the average human. 1,000 humans being driven in a Tesla who are asleep is safer than 1,000 humans on average. Again, on average. Um, but that's not good enough for the regulators. And that makes sense to me. I think regulators should have high standards. So Waymo is very safe, but it's only in some pilot cities, and that is really the Tesla bull argument that once full self driving is approved by the regulators, and once it gets good enough, then Teslas can work everywhere, and full self driving will happen, and you'll have these autonomous fleets. And we've all heard the vision there, and in this enormous TAM, total addressable market. I generally find that when people talk about TAM, uh, it tends to not be a very good investment. I know some people have made a lot of money in venture capital, and TAM is like is probably the most common word in venture capital. But I think people who invest in public securities, who focus on TAM, I think generally their track record is not amazing. I would say I could be biased because that's my view, but I'm not biased against Tesla or biased against Musk. And I think people who have been biased against Musk and against Tesla have suffered, especially those who were short the stock from 2019 to 2021 and its epic bull run. I will say though, Max, I think people who might be biased in favor of Tesla or biased in favor of Musk, perhaps their returns might suffer as well in the future. And I think people really should be rational about this. And for what gets me excited is silver shortages, and I just love doing that. But I try and remain rational and focus on the numbers. And I would recommend that everyone do the same with the stock here. I'll also say, Max, I mean, just looking at the investor deck, like on page 3, they have their commentary, which is 4 paragraphs. Like, I feel like if there was a growth stock and their revenue was down so much, I read a fair amount of company reports, and like most of the time they say our revenue was down, because negative event XYZ happened. Like that language is curiously absent. And they talk about how they've, you know,
They
transitioned from a hardware centric business to a physical AI company. I think this type of language of promising so much in the future rather than talking about what actually happened in the recent quarter financially. I'm very familiar with like that type of language. I'm more used to it coming from like promotional companies that are promising a technology that have very low revenues. I'm not used to it from one of the biggest stocks in the world, one of the biggest companies in the world. Uh, that has a dominant, market leading position. I suppose it could be could be true most quarters, but I think it's just particularly conspicuous to me now, just looking at how long the revenue has gone down. I'll also say, Max, this could be a contrarian bull argument for the stock that, at least on a trading basis, that Tesla's if Tesla's car revenue goes down more, the bulls will just see that it is even better. So yeah, let's have automotive revenue go down 20% year over year instead of 11. Let's have it go to zero because the future is all humanoid robots. And also, Max, the whole argument that used to be true of, well, Tesla's it's not just a car company. You can't compare it to Ford and GM because its operating margins are 20%, whereas Ford and GM's margins are 4%. That argument, from Kathy Wood and other people who, for a time were very successful in the Tesla stock, that argument was very true. You can't compare price to sales if your margins are 5 times higher. It's just not the same. However, Tesla's operating margins for this quarter were 5.7%. So let's be charitable and call that 6%. That's quite close to the margins of Ford and GM. And I don't know to other Chinese car companies how they compare it, but certainly not the 20%. So at some, I think investors in Tesla have kind of been in this what's the word, virtuous purgatory for many years, where like the car revenue has been going down but the stock has been going up because of humanoid robotics, humanoids, and full self-driving. And I think at some point one of those two things has to change. Either the revenue has to go back in the other way, or the stock has to go down. I'm not saying that humanoid robotics won't be a $5 trillion market and that Tesla won't dominate it. That full self driving will finally come after the many years of Elon Musk saying that it will. I'm not saying that at all, but I'm just saying that if it doesn't deliver and the car revenues continue to shrink, I don't see a particularly strong argument for Tesla shares doing well.
Yeah, but he's managed the shell game for this long, so
True.
I certainly wouldn't make that bet myself.
That man can spin more plates than my brain can comprehend. So I agree there.
Yeah. Now, what about now there's one stock which I know you hold, so full disclosure there, but we have been talking and hearing about how AI is going to disrupt software and software companies have been selling off. We did have ServiceNow report today. It is one of the stocks that is down. What did you see in those earnings? And talk to me a little bit about this SaaS is done sort of narrative that is driving these stocks lower.
So Max, I do own ServiceNow. It is compelling. I'd say I'm actually fortunate. It's one of the few software stocks that I do own. So there are a lot of very successful hedge funds. Let's be honest, who they've made themselves and their clients tons of money being long Salesforce, being long Workday. And they are going through a very tough period. Those stocks are in a brutal drawdown, and even the famously high quality compounder Constellation Software, which basically buys software businesses, makes a lot of money from that. Historically, been an extremely good business for a variety of reasons. Even those shares are down, and the narrative basically, Max, is that because of AI, no one is going to subscribe to these software packages. All of this software, which has been such a good business because the retention rate is so high, no one wants to switch. You're embedded. You can raise prices 5, 10, 15% a year. You can upsell them to additional services. And I mean, really, the margins on that, especially the gross margins, are extremely high. I think because the business is so good, and because you do, let's be honest, have to attract a lot of very talented, very smart, very brainy people to create that software and to sell that software as well. Those businesses often have done tons of stock-based compensation. So a lot of the short sellers and the skeptics don't like that. But the fundamental business is quite good. Like I think that I do agree with the claim that software software business is a good business to be in. Like, I'm learning a lot about the metals and mining business, but the metals and mining business fundamentally is a very challenged business. You got to invest tons of money to get something out of the ground. You got to depreciate that investment. It costs,
It
and the
definitionally gets harder, right? The
yes,
the
yes.
assets that you're pulling out of the ground are worse and worse and worse every year. We
The
used to be able
banks
to
know that, so the banks don't want to lend to you. You got to issue equity, yada yada yada. Like, software business is a good business, and ServiceNow is a total leader in that space. I'll be honest. So, Max, I think to be a successful investor, you can't just look at the financials. You have to really understand the company. I've looked at the financials of ServiceNow. I don't fundamentally understand the product, to be honest. So, I guess I get a demerit. I'll assign a wear my dunce hat for that. But just look at the financials. I mean, the retention ratio is so high, like 98 or 99% of customers renew every year. And they have these beautiful charts that basically their most valuable customers are the customers they signed in 2011. So, as everyone knows, your most valuable customers are your customers that you've had for a long time. And in ServiceNow embeds that, and it's just phenomenal business. So it's possible that ServiceNow will be completely eroded, and all these enterprise packages they canceled their subscription, and they just use Gemini or ChatGPT, Anthropic. I think that is definitely possible. Max, I think that certainly that is going to happen for some companies, particularly the smaller businesses that are very cost conscious. Um, I do think there's just a lot of things that like you don't want to have to create software for. So, like, the marginal cost of creating software is dropping enormously. I'm constantly getting ads of like build your own app. Joe Weisenthal, extremely successful financial podcaster from Bloomberg Outlets with Tracy Alloway, like, he's made his own app. So the marginal cost of software is going down. I think then the moat is not the ability to create the best possible software. The moat is the retention, the customer experience, the distribution. While I'm shouting out other financial podcasters, Josh Brown, who is on CNBC all the time of Ritholtz Wealth Management, he's got his show, The Compound, and in an episode maybe a week or two ago, he talked about this stock, Service Titan, and I look through the deck, I don't fully understand it, but the business model is software for plumbers and electricians who have their own business. So, their business makes $500,000 to $5 million, $10 million a year, and they're not billing specialists, especially, Max, we're not billing specialists, and they've got to send all these bills to all these different clients. They've got to show them what they did. It's quite complicated. And Service Titan does that. And so the Service Titan stock, I believe, is selling off. And Josh Brown made the argument, like, is the bear case here really that plumbers and electricians are going to design their own software and create their own apps? Like, I just don't think that is the case. So I think that the baby is being sold out with the bathwater, and there's some rare gems that are being sold alongside the commoditized trash. I don't know what the commoditized trash is, and I don't know what the gems are. Perhaps I'm wrong that ServiceNow is a gem. What do you think about this, Max? And in particular, you interviewed an investor who's been thinking a lot about this.
Yeah, seeing it the same way, like, it is something you're gonna have to go name by name and really try and determine, how sticky is their business. But as well, the pricing models is something that he's really focused on. So, Dea Pernis of Pernis Research is an interview we came out with today, first time on Monetary Matters. So everybody, we recommend go check that out. Interesting factoid: they've been running their research service since 2017. They have a fully audited cash portfolio that they put all of their names in, and they have compounded at 30% since then. So not too shabby. And one of the main things we talked about was what's happening in software. And, it's really nice when you have somebody on as a guest and the whole world is a nail, and they have like a big strong, like, buy horizontal SaaS or buy vertical SaaS or whatever. And it's really not that simple. As you said, you really have to understand who are these customers. But the main thing I would say about the pricing model is, like, the seat-based model. I don't know if you've ever negotiated with any of these enterprise software companies, but it is ridiculously expensive for some of these platforms that there are competitors for, right? And so the question for me is not necessarily, are people going to vibe code their own thing? But like if I'm looking at a company like HubSpot, which I don't know if you've ever had to negotiate with them, it's pretty expensive and they're charging you per seat, and you compare it to some of the cheaper options like a MailChimp out there, like it is stupid how much cheaper MailChimp is. HubSpot is 10 times better, but it's 100 times more expensive in some cases. And you get a bunch of features that you don't really care about. And they find ways to make it so that the one little feature that you want, like you have to up pay for to get. And so if you were a competitor and you don't have that feature and you can produce it much more cheaply and, raise your prices a little bit, but still be ultra competitive compared to what people want, you might see switching. So I'm less concerned about the vibe coding as I am what the sort of tiering of like, this is like the top tier, this is the middle tier, this is the bottom tier solution for small businesses. Like, how is that going to get closer? And how is that going to change the pricing models that we see that make these SaaS companies so profitable? That is the question that I don't really understand. And so, products like a CRM, they apply to every business, right? Like that's something that I think there is going to be competition on. Plumbers, like that you're talking about, like that is highly specialized software for a very specific industry. Like, is there a lowly competitor out there that has worse product than ServiceNow? I don't really know, but you've got Salesforce, you've got CRM, you have all of these non-publicly traded alternatives out there. Like that seems to me like something that there are tiers, there are differences between the products, but it is highly commoditized. And unless you are a massive enterprise, which needs all of the bells and whistles, like I don't know if you're necessarily going to stay with the big boys. And so that begs the question, what percentage of the revenues and profits come from enterprise versus small, medium-sized business? Because the small, medium-sized businesses that I think might be switching and are more price sensitive, they might not really matter, in the same way we talk about like the low end consumer is
Yeah.
really struggling and it's all made up for by the high end consumer. The same thing can be true in software.
Yeah, I think it's specificity. If you make a software service specifically for fishermen, so far there's not a lot of competition in that. Maybe there will be with Vibe Codec. There's also the brand. The globalization, which drove down wages for products, because workers are working in the rest of the world. That made making clothing a lot less expensive. So who had the advantage? It wasn't about if you were, how good the clothes were. It was about your brand. So Louis Vuitton can still command a premium, whereas commoditized products, they can't, even if they're made in the world. So software, I think, is becoming a commodity. So what is not commoditized? The brand, reputation, distribution. I'm also curious, Max, the ability of things to lock in. So the most commoditized thing on the planet, you would think, is computation, and compute. But I think famously, like Microsoft and Amazon actually do have very high retention ratios, because if you're some giant enterprise and your software is on Amazon, you don't want to switch it to Google and Microsoft. That's what I heard. So Max, I'm like your guest, not coming out swinging on either side, but I'd say what prevents me from believing this software doomsday scenario is my belief that these companies can weather the storm and differentiate themselves from some college sophomore who is really good at asking Gemini to write code, or asking Claude to write code. uh Here's where I'm not confident is, I am not confident that the valuation will save them. Maybe I'm deluded, Max, but I feel like I can as well, like, identify certain companies that are so cheap, beyond which it's just ridiculous. These companies are buying back stock. It's trading at 5 times earnings. Okay, maybe I'm deluded in that, but any of the big stocks that you hear about on TV, ServiceNow, Adobe is famously a giant loser in this. Like, their valuations are not going to save them. Just because they went from 50 times earnings to 24 times earnings. If your business is truly going to be disrupted, and your business now is like call centers were 3 years ago, then 26 times earnings or 24 times earnings is not cheap. How about 5 times earnings, or how about your earnings actually go down? And by the way, when your earnings go down and your revenues go down, and maybe your earnings go negative, it isn't just the earnings that contract; the multiple will go down more. So, those are my views.
Well, Jack, this is one of those things similar to how all the AI capex plays out that I just don't think we're going to get the answer to right away this year. Maybe towards the back half of 2026, we're going to really start to get answers where the rubber hits the road. What we know is the market can decide and make up its mind before it hits the tape in the form of earnings releases and actual revenues and profits and all of that. So unfortunately, I don't think it's going to be that easy for all of us to just wait and see. But that's where we are right now.
Max, I've got going to close with two things. The first is, I said, I kind of did some fence sitting on software. People said I was fence sitting on silver. Here's where I will not fence it. I think that the earnings from the AI chip companies, but also other data center companies, but like the NVIDIAs and Broadcoms of the world, are going to absolutely dominate. I don't, not in the weeds on memory, but I know that there's extreme tightness in memory. SK Hynix, which actually reports tomorrow, Samsung, Micron, that the prices are going up. The prices of old NVIDIA chips are going up, perhaps indicating that like the inference demand is just overwhelming. So I've been using my Gemini a lot more. Gemini actually, I think, uses almost exclusively TPUs, which are designed by Google. But I just think that this AI trade and the AI capex data center boom is in its middle innings. And people may say, "Well, Jack, in the late spring, Citrini in 2025, Citrini said it's on its fifth inning, and now you say it's on its sixth inning." Well, that indicates that the innings are going slow. Like, I think that this thing could peak out at 2028. I mean, this thing is secular, and I also think there's a chance that
It's a nice thing
GDP.
about baseball, Jack. There's no clock. Well, now there is,
Yes,
but
yes, and GDP expectations could go even higher. So that is my call. So now we have a call from me. I could be right, I could be wrong. We'll see. The final thing I'll end with, Max, is I actually was asking my Gemini, why is Tesla, its operating expenses went up by so much? Why is that? And the answer is basically it did research and development costs. I'm like, oh, interestingly, and then that just reminded me that research and development, that investment goes through the expense line. So Amazon in 2000 and 1999, 2001, when it was investing so much money in its business, that resulted in a cost, and that came out of its earnings every year. And Warren Buffett has said that actually it kind of made its earnings look too low, and that really that was investment, and that should have perhaps been capitalized, which have made its earnings go higher. So I think like a lot of these software web 2.0 companies that are now completely dominated, maybe their earnings were slightly understated, which is why they have now become so good. I think the opposite is true of AI capex. It's not categorized as research and development. It is being categorized as a capital cost. So the capex is huge, but it doesn't immediately detract from profits. So if in the internet buildup, maybe profits were not the internet buildup, but like 10, 20 years ago, profits slightly appeared to be too low because costs were expensed that should have been capitalized. Now costs that perhaps should be expensed are being capitalized. And so that that sounds like, okay, it's going to end terribly and it's going to result in this giant bubble. Okay, maybe 1 year, 2 years, but in the short term, it can have this steroid effect that I think you've already had, where the earnings look really, really good because the depreciation is going to come in the future, not now. We will leave it there. Thank you, everyone, for watching. Please leave a rating and review for Monetary Matters. Check out Max's podcast, Other People's Money, and go to the link in the description to check out Fiscal and get your 15% discount. Until next time.